Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve's second pause of 2026 is creating a critical inflection point across asset classes, and the message from the Treasury curve is forcing aggressive sector rotation in equities. Here's what traders need to know about the Fed pause divergence and how curve inversion dynamics are reshaping portfolio positioning in August 2026. The Fed held rates steady at its March 18th meeting, keeping the federal funds rate between 3.50% and 3.75%. This pause follows three consecutive rate cuts in late 2025, and the central bank is now watching economic data closely. According to commentary from Merrill Bank of America Private Bank's chief investment officer, Chris Heisey, cited by Reuters, the Fed is monitoring inflation, energy markets, and geopolitical developments as key inputs for its next move. But here's where it gets critical for traders. While the Fed controls short-term rates directly, longer-dated Treasury yields are responding to market expectations for growth and inflation, and those two forces are diverging. Reuters reported on July 31st, 2026 that the Treasury curve exhibited what market participants call a twist steepener. Short-term yields fell while long-term bonds advanced. The spread between 2-year and 10-year yields flattened by approximately 5 basis points in the week preceding the latest data. That 5 basis point move that is signaling something important: market skepticism about future Fed hikes. According to the Reuters analysis, investors are now pricing just a 38% chance of a rate hike at the upcoming meeting. The sentiment has shifted decisively toward expecting the current pause to continue. This divergence between short-end yields dropping and long-end yields rising creates a unique environment for equity sector rotation, and that's where the actionable insights begin. First, let's talk technology versus financials. Technology sectors continue to benefit from relatively lower economy-wide financing costs and strong earnings expectations, even as rates rise at the long end. The logic here is straightforward. Tech companies with robust cash flows and minimal reliance on short-term borrowing see less pressure from the current rate environment. In contrast, financials face headwinds. Banks and financial institutions rely on net interest margins, the spread between what they pay depositors and what they earn on loans. A flatter yield curve compresses those margins. When the 2-year, 10-year spread flattens, banks make less money on traditional lending activities. This structural pressure is forcing traders to rotate out of financials and into tech names that can sustain growth without relying on favorable yield curve dynamics. Next, growth versus value. This classic rotation is playing out with renewed intensity. Aggressive growth sectors, led by technology, are competing against more defensive value sectors as investors weigh forward earnings potential against rising borrowing costs. According to State Street's analysis from early August 2026, the yield curve's message for equity markets hinges on whether investors believe economic growth will sustain current valuations. Growth stocks tend to outperform when long-term rates are stable or declining because their valuations depend heavily on discounted future cash flows. Rising long-end yields pressure those valuations, but if short-end yields are falling simultaneously, the net effect on growth stocks can still be positive. Value stocks, on the other hand, tend to perform better in rising rate environments where economic growth is robust. The current twist in the curve creates uncertainty, and that's forcing active rebalancing. Cyclicals versus defensives is the third rotation dynamic. Cyclical sectors like industrials, materials, and consumer discretionary are being reevaluated given that unexpected rate shifts or further central bank divergence could swing economic prospects. According to Hagan Asset Management's August 2026 fixed income strategy update, the fragile equilibrium in global central bank policy is creating volatility in cyclical earnings expectations. Defensives, meanwhile, offer more stability under uncertain inflation and geopolitical conditions. Utilities, consumer staples, and healthcare are attracting flows from traders looking to hedge against macro uncertainty. Now let's tie this back to hard numbers. The S&P 500 was near record highs at 7,489 on July 31st, 2026. At the same time, the 10-year Treasury yield held near 4.71%. This juxtaposition tells you something critical. Equity fundamentals, driven largely by corporate earnings, are under pressure from a changing fixed income backdrop. The market is climbing despite rising long-end yields, which suggests that earnings expectations are robust enough to offset higher discount rates. But this balance is fragile. Central bank policy divergence adds another layer of complexity. While the Fed has paused, global central banks like the European Central Bank and the Bank of Japan are following divergent paths. According to State Street's weekly economic perspectives from August 3, 2026, some signals indicate that Europe and Japan may still offer hints of tightening or normalization, even as the Fed remains steady. This divergence forces international capital flows to recalibrate, impacting not only equity sectors, but also allocations between stocks, bonds, and emerging alternatives like crypto assets. On the crypto front, Bitcoin and Ethereum are seeing renewed interest as alternative stores of value in an environment where traditional fixed income is under pressure from curve inversion dynamics. Traders are looking at Bitcoin as a hedge against central bank policy uncertainty, and Ethereum's utility in decentralized finance applications is attracting flows from investors seeking yield outside traditional bond markets. Volatility considerations are paramount. Overnight futures are indicating sensitivity to further policy and inflation data, as well as geopolitical developments. According to analysis from Capital Advisors Group on the inverted yield curve's historical perspectives, traders are recalibrating portfolios by balancing exposure across sectors that benefit from lower front-end rates, like tech and growth, versus those that rely on robust interest margins, like banks or cyclical earnings. The positioning of fixed income portfolios has become an essential part of hedge strategies against equity volatility. Here's the actionable takeaway. In the current environment characterized by a Fed pause keeping short-term rates steady at 3.50 to 3.75%, an unconventional yield curve twist, and divergent global central bank policies, equity sector rotation is aggressive and ongoing. Traders need to focus on overnight futures, key technical resistance levels, and broader economic indicators to navigate this fragile equilibrium. Technology and growth sectors offer upside if the Fed pause continues and short-end yields remain suppressed. Financials face structural headwinds from compressed net interest margins unless the curve steepens significantly. Cyclicals are vulnerable to central bank divergence and geopolitical shocks, while defensives provide stability. And crypto assets like Bitcoin and Ethereum are emerging as alternative allocations in a world where traditional fixed income offers uncertain returns. The 5 basis point flattening in the 2-year 10-year spread, the S&P 500 at 7,489, and the 10-year yield at 4.71% are the concrete data points defining this critical juncture. Portfolio positioning requires precision, active monitoring of Treasury curve dynamics, and a clear thesis on whether the Fed's pause will hold or shift in response to inflation and geopolitical developments. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.